you. Today is Tuesday, 31st of March, 2026. Today is month end, quarter end. My name is Francisco Gaffney, and this is my daily streaming all about governance, risk, compliance, and advisory boards. Yesterday, I talked about scale or scaling a company, brand, people, and partnerships, and the things that help a business grow faster. But here's where the board's executive teams and founders get caught up. A business can grow and still become less reliable. And you say, how that come? Well, more sales, more activity, more meetings, more pressure, but less trust in the numbers. So less confidence in the forecast, less certainty about cash. So today we move to the next part of the system, which is predictability, right? So what constitutes predictability? And I'm going to show you here in the model that is coming up in the screen. And predictability is talking about the partnerships, the revenues, and the assets, right? So what are you said? So this helps you to grow and growth and address with capital that makes your company predictable. And we're going to go deeper today in how that works. So allow me 1 second, and I explain you why this matters. And why this matters now. Because the market is not rewarding noise, it is rewarding clarity. If revenues are lumpy, margins are unclear, and working capital is tightening, and then the board, the executive teams, and the founders still cannot explain what sits behind the forecast, then growth starts to feel fragile. And that is when management teams get dragged into defending numbers instead of improving them. And I'm going to go through an example today of a company that we are working with. And this is a perfect, and actually we started to work with them yesterday because this is a perfect example how predictability started to get very wobbly for this company. Now they want to exit, they want to sell. So this is where I come in as a board advisor. I build a rotating international advisory board around the milestones in front of the company, so you get the specialist capability you need in a fraction of the time it takes to hire one executive, right? So you can hire a very good executive, but it takes a lot of time, but probably hundreds of thousands of pounds, dollars, or euros. So, and this is without the consulting overhead, without the talent locked in, and with the members swapped every 6 months as the project evolves towards what is your aim and the goals. So let's get into the uncomfortable part of it. Predictable growth is not about sounding confident. It's about being able to prove what will happen next and why. So let's take a look at three problems with this. The first one is, I would say, simple. Too many boards, executive teams, and founders still clap for revenue and ignore why shaky the engine is underneath. And I'm going to show you this example now, but let me show you this first. EY, the Ernst & Young consulting firm, says the UK listed business issued 240 profit warnings in 2025. So that tells you plenty of boards, executive teams, and founders still got the story wrong. And this is something more. The Office for National Statistics then reported that businesses investment fell by 2.7% in the Q4 2025. That is 3 months ago. So even where firms want to grow, many are doing it while holding back on the assets and systems that will make the growth more dependable. Now, you say, what does have to do with me? Because I'm not a listed company. I'm not a company that actually are close to these kind of complexities. You are, even if you don't know, because actually the mechanics and the principles are exactly the same. And this is the example I mentioned. Yesterday, we were contacted by a company because they want to exit the market. And guess what happened there? The numbers look very, very good until we look into the receivables, or actually the invoice unpaid, the collection portion of the company. 1.2 million they're sitting, and they say, where is that money? I say, oh, that is 2025, and we are hitting Q1 end 2026. They haven't collected 1.2 million from last year, and they don't know how to, right? So now today it will be a very interesting day to understand what happened with that collection. But this is another thing I'm going to mention across this conversation today. They are constantly forecasting that 1.2 million as about to be collected, right? But actually, where's the collection? And this is affecting everything else, right? So in numbers look good, but effectively is a very complex situation. So the second problem that I want to mention today is capital without the confidence, and this is part of the example. And here's one thing from the Financial Council Authority that says 1.9 billion was raised through 11 IPOs in 2025, which shows capital is not dead. Yeah, when you're looking for investment or stockholders, etc. So it's not that there's no capital available. But the Bank of England also says the investment intention remain weak, with little planning to increase growth or capacity except where firms have financial headroom. And what all this means, that is the real board challenge here. The capital exists, opportunities exist, but predictability is the filter. If the numbers feel soft, the market becomes hard. So what I'm saying with this is that even if you say, oh, well, but that's, again, it's a public listed company. They floated the company, it's an IPO. But also happens when you are going to exit your organization. If you're a limited company, if you're a founder, a group of founders, and you want exit, and this is a problem that we have with this company that started to work with yesterday, is actually you start to see the numbers, and then investors go and see, I'm not sure that this actually, the valuation of this company is right, because they have there 1.2 million that have not been collected since last year. And this is Q-end 2026. So what's going on there? So it's not that the opportunities don't exist. It's not that the capital don't exist. It's a preparation is not there, right? So the third problem sits inside the board pack or your data set or the data room when you are trying to exit or raise capital. And here's something from Deloitte that says that only 15% of CFOs thought it was a good time to take greater risk onto a balance sheet at the end of 2025. This is 3 months ago. Well, below the long run average of 25%. What this means, okay, I say what all that means. This means two things. One is a drop of 40% of the average, meaning that actually, if before 25% in average will take risks in terms of investment or actions in a year, now it's 15%, right? So that's a drop in the appetite for risk, as they call it. So external uncertainties, this is what some of the reasons. And external uncertainty was still rated high or very high, right, by CFOs in the UK in the terms of competitiveness and productivity remaining as one of the top risks heading into this year, 2026. So, but here's a challenge. They drop the risk because of competitiveness and productivity. But then in the middle of Q1 this year happened this conflict in Middle East. So you can imagine that if the risk appetite decreased, and then you have based on two reasons, with this competition and production, and then all of a sudden you have an oil crisis, a petrol crisis, a diesel crisis in the middle. That's something that you perhaps, as far as I'm concerned, nobody was forecasting anywhere. So it was, oh yeah, it's a conflict there, but actually nothing happened. And all of a sudden, a month ago, bombs start to fly all over the skies in the Middle East. So in plain English, what I'm trying to say is that boards, executive teams, and founders are being told to be careful. So if your forecast still leans on best case sales assumptions, delayed cost pains, or assets that are not generating sufficient returns, sooner or later the business loses credibility. And this is not the things actually about productivity. Productivity and competitiveness is about how you structure your organization, how you value your organization in a way that actually can sustain all these shakes of the market and geopolitical things. And I mentioned this a few times already. Even if you are operating nationally, and many companies are telling me this, I say, well, we operate nationally. That has nothing to do with us. Why should we worry about that? Well, guess what? So if you're in an industry where your vehicles require carburants like oil, diesel, etc., you're already in trouble because you haven't forecasted in your slightest this increase of um, petrol or diesel costs. Anyways, this is not to show it's not to go into negative, it's just to show you all these problems can be addressed. In other words, you can imagine that this unpredictable growth is like building a taller house on a wet ground. So from the street, it looks, yeah, great, fantastic, looks big, wonderful. But under pressure, when the things are started to get in pressure, you say time, wind, etc., weather, the cracks start to show because the ground can sustain, the foundation can sustain that bigger structure. So the question becomes this: if more revenue does not automatically mean safer growth, what does the board, executive teams, and founders need to measure and redesign to make performance repeatable? And here's the keyword: performance repeatable. Yeah. So if you want to boil it down to one word, is repeatability. How you can repeat this again and again and again, regardless of the circumstances around the organization. And then we spoke about relevance too. And this is a chapter we spoke last week, so you can check that videos from last week. Now, as a board advisor, what I would propose to consider is the following. The first thing is separate revenue size from revenue quality. And this is back to this example. So in terms of revenue, it looks very good. In terms of quality, it doesn't look good because the collection is not there yet. So the money in this company that is missing 1.2 million in collection is not good in this quality because it hasn't hit the bank account yet. So the boards, executive teams, and founders need to ask where revenue comes from, how often it recurs, and how concentrated it is. So how quickly it turns into cash, and what level of discounting or customers' work it's hidden within it. And what I mean with all this jargon, I'm sorry for that, is that this perfect example. So in terms of quality, speed, hidden problems, etc., you have in paper, like invoices, etc., 1.2 million. In the bank account, it's not there. So this is the things I should say, well, that is obvious. Well, it's obvious, yes, but actually, how it come that a company still dragging this from 2025 to today, 2026, Q end, today, 31st of March, 2026, is still happening. So when the people say it's obvious, it is obvious, yes. And I'm kind of sure you that when I went through the quarter end reports, days since Q1 last year and Q2 last year, this money start to come up as a forecast for collection. And today, I'm sure that the report from Q1 end is going to show again as a forecast as collection. It's not going to come up as a cash in bank. So a bigger top line is not a win if every pound takes too long to collect or costs too much to keep, right? So second thing that I will advise is make assets answer for themselves. And when assets are not just building and machines, they include working capital, data channels, customer relationships, and technology. So the board, executive teams, and founders should ask one blunt question: which assets are making revenue more predictable, and which ones are soaking up cash while pretending to be strategic? So if no one in the room can answer that clearly, the board or the executive team or the founders is not steering capital, it is drifting through it. So it's drifting capital to things that are not productive, or they are just spinning the wheels. And I have an example last week about this that probably makes all this jargon much simpler to understand. In 1997, Steve Jobs, when he was brought into Apple again, one of the first things that he did was to discontinue 70% of the production line, right? 70%. That was around 210 products or something like that. And everybody thought that he literally annihilated the company. That is kaput, is gone. Well, the opposite really happened because he realized, or the explanation was at the time that actually, and I still stand, that competing one-to-one with other organizations in terms of printers, cartridges, pods. They have the Newton at the time. That was a kind of early stages of the iPads, etc. They have too many products that were competing head-to-head with other companies, and was literally drifting capital resources and time into a little feature here, a different color there, a better marketing campaign, but it was not moving the needle of the organization. So 70% was gone, and the focus was into the things that were more advanced, innovation, transformation. And we're going to talk about transformation and innovation on Thursday this week. So you will see better examples of how this means. And the third thing that I will advise is run the forecast like a board tool, not a financial ritual, as this company. They all look at the forecast. Okay, great, excellent. But use it as a tool. And what I mean this is a good board does not share at one number or don't stare to the dashboards or the reports and say, is it one number is good and we hope that everything's going to be fine. It pressure tests assumptions, right? So what sleep first is, and if demand weakens, right? What happens to cash if conversion's low by 10 days? Imagine this 1.2 million dragged for almost 9 months without collection, not 10 days, 9 months. Which customer regions or product lines cause the largest forecasting errors, right? So the example of Steve Jobs. So predictability improves when the board, executive teams, and founders keep asking what will need to be true for this plan to hold. And this is what makes things more predictable, regardless of what's going on in the environment. What will need to be true for this plan to hold? Now, here's the next challenge. If the board can see the weak spots in revenue, cash, and asset use, how do you bring in the right capability fast enough to fix them before the next half year report, right? So what I mean is actually, okay, we identify this issue, and this happens very frequently. You bring a stellar consulting firm, they meet with you for 2 weeks, 3 weeks, a month, and then they produce a wonderful presentation, a PowerPoint, sometimes hundreds of pages, sometimes like 20, 50, 40 pages, and they document everything that you said to them. And they say, thank you very much, that is your report. What is solution? How we can address all these things? We already know these things. We told you what's going on. Yeah, we articulated. You articulated better. It's a nice graph, a nice design, but what exactly we have to do? And this is what you gain working with me. I bring you 3 things that are very important: outcomes, business outcomes, how you differentiate, and how I reduce your risk. In terms of business outcome, in this graph that you see in front of your screen, I bring the advisory board operating system. It's a growth and capital through predictability. The job here is to make revenue easier to trust and capital easier to deploy with confidence in the right things. And remember the example of Steve Jobs. So the outcome is a board that can see around corners earlier, they challenge assumptions sooner, and move from hopeful forecasting to evidence-based planning. In terms of differentiator, my model lets you add the exact capability the milestones need. So if you're looking, for example, collecting this 1.2 million, this is exactly one milestone. It's a precise number of how we're going to collect this and what are the challenges that we need to sort out. So that might be a former CFO to bring to the table, a capital market operator, a pricing specialist, a commercial leader, or someone who has already built predictable revenue at the stage you are entering, right? So the system starts to pull you towards your objectives instead of you trying to push your way into, or put a round peg into a square hole, right? So you don't need to wade through a long executive search and hope that one person solves it all. It's a task of a team of specialists, and you get a rotation international advisory board built for the problem in front of you. And every 6 months, we sub talent as we needed as the project progress. In terms of risk reduction, This lower risk because the predictability problems usually sit across functions. So sales says one thing, finance says another thing, operations sees the strain late, a rotation board gives you a cross-functional challenge without the drag of a big consulting project, without the equity dilution, and without locking yourself into a static board mix when the business may need a different shape 6 months from now because the talent requirement is different. So one action you can take today, and is you can do it in less than 30 minutes or so. Before your next meeting, take one revenue line or business unit and ask for five numbers. Yeah, number one, repeat revenue share. Number two, gross margin. Number two, cash conversion timing. Cash conversion timing. So how long you take from collection, so from invoice to collection. Customer concentration, which customer that have the biggest revenues or the lesser revenues or the biggest problems or less problems to collect, and forecast variation over the last 2 quarters, not 3-4 quarters later. In the next or the last 2 quarters, so actually you can build a trend of where you have to put your efforts or not, right? So if you are UK chair or UK or any other country, because we are servicing other countries too, non-executive director, executive team, and you want an international advisory board built around the milestones in front of your organization, you got a specialist, you want specialists, capabilities faster than hire one executive without the consulting overhead and without the talent locked in. Book an advisory call with me to do an assessment, and we are going to understand. I would love to understand where you are standing today. What is your challenge? What's your problem? And I will build around that how to build predictability that will work in your business, particularly in your particular business. So let's pause it here for today and reconvene tomorrow, because tomorrow I'll go deeper into system. And system, remember, is not always softwares, are controls and resilience, because once the board starts trusting the numbers, this is a process that we went today, the next question is whether the business could still operate if the pressure suddenly hits. And remember, for example, a point of pressure today is that whatever you plan in Q4 last year, all of a sudden in Q1 this year, at mid-quarter, a conflict in the Middle East all of a sudden start to throw all the plans around, and you have to start to reshuffle the whole thing again. Even if you have to do that, having an international advisory board that looks into your problems in a different way, and that's why I say international, because the cognitive diversity of international advisors is not the same of people that lived and done business in country all the time. You need them, is their expertise, is their intellectual property, is their experience, but at the same time, different views from different countries address the same conflicts in a very different manners that bring absolutely fantastic solutions. See you tomorrow.